Today we're going to be talking about liabilities. And with liabilities, we're going to be talking about both current and long-term liabilities. Let's first consider current liabilities. And a current liability is defined as an obligation due in 1 year or the business cycle, whichever is longer. So we're talking about things that we will have to pay within 1 year or less. Long-term liabilities, on the other hand, are obligations due in more than 1 year or the operating cycle, whichever is longer. And here we really mean liabilities due in longer than 1 year. The only case I'm aware of, and I actually worked a little bit with this, where the operating cycle was used instead of a year is the Olympics, where the Olympics are on a 4-year cycle. And an international accounting firm that I worked with did accounting for the Olympics and looked at for the entire 4-year period as if it was current, and anything longer than 4 years was considered long-term. But that's rare. Let's consider common types of common types of liabilities, and accounts payable is one of them. So the common types are accounts payable. Generally, this is ongoing transactions where a merchandiser buys inventory, and they don't buy inventory by paying up front. Rather, they order the inventory and promise to pay within 30, 60, or 90 days. Just as a little aside, when Walmart drove Kmart to bankruptcy for the first time in 2002, Kmart had a little trouble paying and didn't pay its accounts payable on time. So creditors started to make them pay up front before they could get merchandise in the store. Meanwhile, Walmart to this day really operates as sort of a consignment operation, as do most retailers. So here, Walmart orders the merchandise, you buy it from Walmart, and sometime after you buy it, within 30, 60, or 90 days, Walmart turns around and pays the bill. You can see how if you can get merchandise into your store on consignment and pay it only after it's sold, you're in a much better position than if you have to wait until you can actually pay cash for inventory. There are other types of liabilities. Sales tax payable is one, and that's always a current liability. Think if the government is ever waiting for money and it's due now, it's due now, but you owe the government, would they wait longer than a year? Answer is no, it's always current. Unearned revenues are cases where, like ticket subscriptions are the most common case. Think NFL's season tickets, ODU football season tickets, thing like this. You pay up front, and so if you look at it from the perspective of the business gets cash up front. That's a liability when the business gets the cash, and then as the business earns it, as the team plays games, then the liability is reduced. Notes payable are similar to accounts payable, but they're written or contract. There's some kind of contract out there in a writing, and usually interest is charged. It could be a current note payable. Sometimes these are called short-term note payables, or it could be called long-term note payable. Again, depending on the year or the time frame in which it's due. Also, I just want to point out that a note payable can have both a current and a long-term portion. You have to be careful with this. So if you have a mortgage that's not due for 30 years, but there's a payment due every month, the first 12 payments are current. Everything after that is long-term. Now in our class, you won't be hit with having to classify some notes payable, the same note payable as part short-term and part long-term, but in more upper-level classes, you really would. Here are more types of liabilities. Wages payable, and again, ask yourself, would you ever earn the money and be willing to wait longer than a year to collect it? I think not. So wages payable is always current. The money's due now. Payroll taxes, these are, now I want to clarify, payroll tax withholdings are cases like the employee portion of Social Security and Medicare. And these are liabilities because the company has taken them from employees, but the company owes them to the government. They're short-term or current. On the other hand, some payroll taxes are owed by the company. They're not withheld. Take, for example, the company's portion of Social Security or Medicare, or unemployment in Virginia, which is taxed only to the employer, not the employee. This is also short-term or current, but it's separated from withholding liabilities that employees owe. And the company's just responsible for paying. Let's look at an accounting example for current liabilities, and then we're going to look a little bit later at a long-term example. But let's first look at the current example. So here we have a case where a company owes its employees wages. The employees have work now. And typically, and you're probably familiar with this, companies don't pay in cash much anymore. So when the employees earn the right to money, the company's going to debit wage expense. And that'll be, as I said, a debit for, in my example here, $50,000. Well, they didn't pay yet, so cash would not be the credit. Instead, a current liability, wages payable, is credited for $50,000. And even though I didn't line it up right, I probably should have had the date out here to the left. You can see on the bottom, I'm telling you that this date is January 1st. Then, on January 31st, the company pays the bill. So here they debit wages payable, and if you look at it, it was credited for $50,000 in the first transaction, debited for $50,000 in the second transaction, no balance. Cash is credited $50,000 because the bill is paid now. And the red statement at the bottom says, don't double count this. Don't make both debits wages expense. The first debit is wages expense. That clarifies it's wages expense. The second debit is only to relieve wages payable. Well, let's now turn our attention to the most common long-term debt that a company has, and that's bonds payable. And the CPA exam and upper-level classes will really dwell on bonds. This is one of the reasons we give them a treatment even in an Accounting 211 class like this. However, we're going to make a very short, very simple treatment for now. So I'm going to set up an example, common example, where a company like Walmart issues $800,000 of 9% 20-year bonds dated January 1st, 2015. And get your terminology straight here. When Walmart's issuing bonds, it means it's borrowing money. It's issuing like a bond document. It's borrowing money at 9% interest for 20 years, and it'll pay back the money later. Why would Walmart do this? Well, here's the most common reason. Perhaps Walmart wants to do something kind of crazy or innovative, not something that you might think of as standard. For example, Walmart might want to hire 60 new people. This would be a very small hire for Walmart, just a few stores in Southampton Roads, for example. And it might want to do this to improve service, but it really doesn't want to go to the bank and ask for $800,000 because the bank might want very detailed plans. The bank might start second guessing whether it's a good idea to have new employees. And also Walmart might not want to provide collateral. So instead, they might just want to issue bonds. They might just want to go to the public, usually through a stock exchange, like the New York Stock Exchange, and say, buy these pieces of paper, buy these bonds, loan us money, and we promise to pay you back 9% over 20 years. And we've got a great record of doing that. You know, and Walmart's record is stellar. It's never defaulted on a bond issue in 50 years or so. So creditors know if they loan Walmart money, they'll get paid back. So the bond accounting for this typically is that it's rare that the market rate of interest is the same as the contract rate of interest. So I told you the bond contract has 9% stamped on it. But if you've ever tried to get a mortgage, you'll notice that if the market fluctuates by 1/8 of 1%, for example, if it goes from 9% to 9.125%, or 9% to 9.875%, that's considered a change in the interest rate between market and contract. So in my example, it's much beyond the scope of this class to show you how I calculated it, but I assumed that the market rate was 8%. So if the market rate's 8% and the contract is 9%, this borrower is going to get paid more money each 6-month period, each semi-annual interest period, than it should. So these bonds are issued at a premium. We're actually going to ask the bondholder to pay more than $800,000. So indeed, I did the calculation. I didn't show you how to do it, and you're not responsible for it. But bondholders were asked on January 1st, 2015, to pay $884,179.22. The amount that they'll get back at the end of the 20-year term is $800,000, but they're also going to get semi-annual interest payments. And so the premium on the bond payable is the difference between $884,179.22 and $800,000, or a premium of $84,179.22. And the bottom note tells you that an account like premium on bond payable is considered an adjunct liability. I've got a slide on this in a minute, but we're going to see that that account number is usually right behind the bond payable itself. Here are the journal entries. The one for basic interest is debit bond interest expense, $33,895.22. Debit premium on bond payable, $2,104.48, and credit cash. How do we get there? The cash is the easy part, and that's the first calculation I show you. $800,000, the bond amount, times 9%, except the company pays this, and this is common, the way almost all bonds work, twice a year, June 30th and December 31st, or July 1st and January 1st. And so the amount of interest paid is $36,000. So that's the credit. It's easy enough. When we have a premium like this, the view of accountants is that using the accrual basis method, this premium should be transferred to a reduction of interest expense. Remember, this was upfront interest, so this should reduce bondholders' interest expense every 6 months until the bond is actually repaid. So we do a straight line calculation here, and the straight line calculation takes $84,179.22, the total amount of the premium, divides it by 40 years, and we're going to amortize $2,104.48 every time we pay interest. So the bond interest expense then is not the full $36,000. It's only $36,000 minus the premium amortization, or $33,895.22. This is the last page in my example, and it just shows you how some of these accounts would look. Remember, T accounts represent general ledger accounts, and we just want to see how it would look at the end of these transactions. So the first transaction, debit cash $884,179.22. You see cash going up here. We also have bond payable going up with a liability, that's account 230, and the premium going up $84,179.22. Those three entries make up the initial posting to the general ledger. Later, the second entry that I mentioned to you debits the bond interest expense, which you see here in the bottom. It also debits cash. And notice it reduces the premium on bond payable. So now our balance, our adjunct liability balance, is $82,074.48. So oftentimes accountants will say the carrying value of the bond payable then is not a full $800,000, rather it's $800,000 plus the remaining premium, $82,074.48. And after 39 more interest payments and amortizations of premium on bonds payable, the carrying value on bonds payable on the date that the money is repaid by Walmart to shareholders would be $800,000 even. That would be the carrying value at that point. Let me know if you have any questions about this, and good luck with the liabilities chapters. Take care.